All right, this video is going to work through problems, what is this, 10 through 14 from the 2018 exam 2. So you're given static and actual budget for Wildcat family practice, annualized, and the first thing you're asked to do is calculate the revenue variance for the family practice clinic. Okay, so this is actually a pretty straightforward question. Revenue variance. So let me, so what I'm going to do is I'm going to copy out just the revenue portion for, well, yeah, I'm going to copy out just the revenue portion here. So we've got revenue, fee-for-service, capitated, and total, and we have static revenue of 833, capitated of 417,600, and total therefore of 1250, 600. So static, that's what we thought we were going to get, and then actual fee-for-service is 791, 700, capitated was 417, 600, and total is 1209, 300. Okay, so we want to know revenue variance. Revenue variance is simply revenue actual minus revenue static. So this is actually pretty simple. So revenue actual is 1209, 300 minus 1250, 600, which gives us 1209, 300, 1209, 300 minus 1250, 600 is minus 41, 300. So interpreting this, they thought they were going to earn 1.25 million. They actually earned 1.2 million. So they underperformed in terms of revenue by 41,300. So if we were looking at the profit variance, 41,300 of the profit would be explained by an underperformance in revenue. All right, part 2 asks, decompose the revenue variance into its two subordinate variances. Now we need flex variance. Okay, to do this, to get flex, the important thing with revenue is to remember what drives the different categories of revenue. So in this case, we have fee-for-service and capitated. Remember that static is price expected times volume actual. Actual is price actual times volume actual, and static is price expected times volume actual. What drives fee-for-service? Revenue. It's going to be the price per visit that you charge times the number of visits. So expected, not actual. Sorry. Price per visit times the volume expected. Price expected times the volume expected. So we thought we'd get some dollar amount per visit times the number of visits that we thought we would get. That gives us our fee-for-service amount. Capitated is a different animal. Capitated is the price per covered life that we would get, and the volume is the number of covered lives. So in this case, volume is visits. In this case, volume is number of covered lives. So you can't add these two together and average them out. It's an apples and oranges comparison. So you have to be careful with that. So our benefit here, though, is that capitated does not change. So that means that the flex is also the same, because if you're the same in static as you are in actual, then your flex is the same. Fee-for-service revenues, we need to know what the expected price was. We have the expected volume. We're told that the expected volume, if you go back to the problem, the expected volume or excuse me, actual volume in this case, what we care about, is 9,100. So VA is 9,100. VE we're also given. VE is expected is 9,800. So if the fee-for-service revenue expected is 833, and it is equal to the price, expected price times the expected volume, then we have the expected price, and we know the expected volume was 9,800. We can divide by 9,800 on both sides. And we get price expected is equal to 85. So the fee-for-service flex then is the expected price times the actual volume. So the expected price is 85. The actual volume is 9,100. So 85 times 9,100 gives us 773,500. So now we have the flex revenue for fee-for-service. We can add that to our capitated for 17,600, and we get 1,191,100. This gives us the information we need in order to calculate the subordinate variances for revenue. Just one clean piece of paper. So revenue variance is equal to price variance plus volume variance, right? So we want to calculate price variance and volume variance. Which columns do we use for price variance? Well, we want to use the columns that allow price to vary while holding volume constant. So that would be fixed and actual. So price expected, price actual. So we're going to take price variance is going to be revenue actual minus revenue flex. So that's 1,209,300 minus 1,191,100. So 1,190,100, we'll make that negative. Add 1,209,300. We get price variance is 18,200. What does that tell us? Well, our revenue variance, which we calculated was negative 41,300. We actually had a positive price variance of 18,200. So our prices increased, right? Our price per unit increased, holding volume constant. So that means that our volume variance must be down quite a bit. So volume variance for revenue is going to be revenue flex minus revenue static. Revenue flex is 1,191,100 minus revenue static 1250,600. So 1191 minus 1250,600 is minus 59,600. So while our prices went up and increased our revenues a bit, our volume was down enough that it drove down our total revenue. If we add these two together, negative 59,600 plus 18,200, we get the 41,400 that we calculated for our revenue variance. Okay, so that is problem 11. Problem 12 asks us, evaluate Susie Q's efforts in controlling variable cost per visit. Was she able to reduce variable cost? Use the appropriate variance to show whether she was successful or not. All right, so now we need to go look at our costs. So our costs, in particular, we're interested in variable cost, but we can look at the overall cost. So variable cost was 609,000, fixed costs were 400,000, and total cost was 1,009,000. This is our static. We'll need our flex, and our actuals were 549,900, 400, and 949. So fixed costs came in correctly. And so we really just need our fixed cost, our flex variable cost. Okay, so flex variable cost is price expected times volume actual. We know that so in this case, in this case, we want to, because we're using, now we're talking about variable cost. What drives variable cost? Variable cost is driven by the number of visits in this organization. Whereas revenue, right, capitated visits are not driven by, capitated revenue is not driven by capitated visits. It's actually driven by capitated lives. Under costs, when we talk about costs, variable costs, it doesn't matter how the visit is being paid for. It only matters what it costs to produce a visit. And so producing a visit for a fee-for-service patient costs the same as producing a visit for a capitated patient. So we're going to use the total visits, right, to calculate price per unit for variable cost. We're not going to differentiate between a fee-for-service patient and a capitated patient. So we're going to use that total visits of 14.5 as our static, 14.1. So volume expected was 14.5. Volume actual 14,100. Let me switch back. Okay, so in order to get the flex variable cost, I need to calculate what the expected cost per unit or price per unit, variable cost per unit was, and multiply it by the actual volume. So the expected variable cost was 609, right? So, and that decomposes into some expected price times the expected volume of 14,500. So if I divide both sides by 14,500, so 609 divided by 14,500 gives me a expected price of 42. And then I have the actual volume is 14.1, so the flex cost is going to be 42 times 14,100 equals 592,200. So I add that to my 400, I get 992,200. So now I have my flex costs, my static cost, my actual cost. And so the question that we're trying to answer is, did Susie Q do a good job controlling variable cost per visit? Use the appropriate variance. So which variance would we use to talk about whether Susie Q, the manager, has controlled costs? Well, management variance is the one that allows us to compare costs. So this is price expected times volume actual. This is price actual times volume actual, right? Actuals. And so it's the comparison between actual and flex. So management variance equals the cost flex minus cost actual. And notice we're going left to right instead of right to left like we did with revenue. Why? Because we want the actual to be smaller than the expected. Because with a cost, if we said, hey, we're going to spend 100, but we actually spent 80, 100 minus 80 is 20, positive 20. Positive 20 means positive means a good thing, right? If we spent 100 and we thought we'd spend 80, 80 minus 20 would be negative 20. That means we overspent by 20. That's a bad thing. So that's why we do this order. So cost flex, 992, 200 minus cost actual, 949. 992, 200 minus 949,000 gives us a positive 43,200, which means that Susie Q did in fact do a good job managing costs. She reduced them by $43,000. And we can verify this relatively easily. We thought we would spend $42 per unit on variable cost. What did we actually spend? Well, we actually spent $549,900 divided by our actual volume of 14.1 gives us, so we actually spent $39 per unit. But remember, this problem asks you to use variances, not calculate the actual number. If you calculated the actual number, I'll give you some credit. But what I would take off points because you didn't actually calculate it using the variances. All right. Question 13 says, what was the PMPM that Wildcat Family Practice received? All right, switching back here. So per member per month. Okay, so how much? So what we care about here is the capitated revenue, which was 417. So they got 417,600 in capitated revenue, as well as the capitated lives, because we can. So the question was, all right, that's not going to work. So the question was, how much revenue per member did we receive? I think actually per member per month. So yeah, 13, what is the PMPM? Okay, so our capitated revenue actual was 417,600. Our capitated lives was 1,200. So our per member per year, right, because this is a total per year, is 417 divided by 1,200. 348. And our per member per month is going to be 348 divided by 12, because that would be an annualized number, or 29. So their PMPM was 29. And then last but not least, how effective was the clinic at managing the utilization of services by the capitated patients? Quantify your answer in terms of a beginning and ending utilization rate for the capitated patients. All right, so let's go back. Okay, so here, remember, so what are we really asking about? Remember, we get a fixed amount of revenue, our capitated revenue, for our capitated patients. And when we are doing capitation, our motivation is we don't get any more money if we see our capitated patients more often. So our goal is to manage their utilization, meaning manage the number of times they use our services. Basically, keep them out of the clinic because every time they come to the clinic, they increase our variable cost. So we care about, in terms of utilization, what we're asking is how many visits did per capitated life did we expect, and how many visits per capitated life did we actually get? So how many visits did we expect divided by number of lives? How many visits did we actually get divided by number of lives? That'll give us our two utilization rates, and then we can compare them. So our expected capitated visits, static, say, cap visits was 4,700. Our actual cap visits was 5,000. Our capitated lives expected was 1,200. Our actual number of capitated lives was 1,200. So 4,700 divided by 1,200 is 3.92. Our actual was 5,000 divided by 1,200, 4.16. 4.17, whatever, it doesn't matter. We had an increase in utilization. In other words, we thought each of our average patient would do 3.92 visits. They actually did 4.16 visits. So we did not do a good job managing utilization.